Welcome to the F Sharp Podcast, presented by Harmoney Wealth, a podcast geared to educate you on all things financial. Co-hosts Tanner Bortnam and Adam Henning discuss various financial topics presented in a consumable and entertaining manner. Tanner is a certified financial planner, JD, and financial expert, while Adam is a marketing professional and small business owner. It's time to harmonize. Sit back and enjoy the episode. Your future self will thank you.
Welcome to episode 37 of the Financially Sharp podcast presented by Harmoney Wealth. I'm Adam Henning, marketing professional and small business owner, and I'm joined as always with co-host, certified financial planner, JD, wealth manager, and Super Bowl champion, Tanner Bortnam.
That's right.
Are we going to go with
Go
that?
Chiefs. Go Chiefs.
I'll give you your 30 seconds here to just do what you need to
Oh,
do.
no, it's all good. Well, this is our first episode where we're recording the video, so
Yeah, welcome
for anyone
to YouTube.
watching that, I apologize for the color combo clash. Won't happen again with the red and purple background. But, I mean, how many times do you get to, have an episode right after the Super Bowl where your team's won? And this is our first, obviously, so definitely felt like got to represent the Chiefs, have my Patrick Mahomes jersey on, and what a great weekend it was this past weekend when the Super Bowl. So on cloud 9 right now.
Did you go to the parade?
No,
I know
no,
the answer.
I did not fly back to Kansas City for that. I watched it, but I didn't fly back.
One
So-
day the Vikings will get to it.
Yeah, that's right. Someday you'll get there.
Oh, right there.
Yep, the other way.
That's why that's why the logo and branding is purple. It's because you like the Vikings second best. That's a joke.
No. Yep. But it does match up well with your team's colors.
Yeah, it does. I have to ask you, are you feeling a little bit more nervous / under the microscope now that we are on the video? I have to be on my best behavior here, I guess. I guess I'm in control of the screen, so you can't really tell. So you're always just gonna have to, be
Yeah,
on. But this is what we
that's
look
fine.
like. This is what we look
That's
like.
right.
If nobody knows who we are, have found the podcast and didn't know who we were before this. This is what we look like. Hopefully that's good, bad, or indifferent. It is what it is.
So hopefully not bad. Hopefully just good or indifferent.
Yeah. So, all right. Episode 37 is a market update. So we're gonna talk about quarter 4 of 2022 as we're recording this in mid-February. So we're a little bit behind from a market update standpoint, but we'll just lead that off here with a market update. So what do you want to start with there, Tanner?
Yeah. Well, let's just kind of start with the market itself. For anyone who hasn't or is new to the show and hasn't heard any of our previous market updates, basically what we do is just try to once a quarter, like Adam said, we're a little behind on this one, but I think it works out well because we've had a lot of change at the start of the year that we can go over as well. But we just want to give an update on what's going on in the markets, what's going on in the economy itself, different things, and try to, we're never going to project or give any recommendations on the show, but just chat about what's going on, what we think may be coming in the future, so that any of our listeners are better prepared for anything that is coming up or potentially coming up. So let's just start with the markets themselves. Q4, so to end 2022, the markets weren't really that great in quarter 4. October was pretty good, but then we gave up some of those gains in November and particularly December. But then to start the year, January was a really, really good month. So where we are now here in middle of February of 2023, markets are up 7.2% as of today. Year to date, which that's a really, really strong start to a year. If you look back, over 100 years, the market itself averages somewhere between 8-10%. So for us to have 7.2 of it already in 1 month is really good. But we're still down about 14% from our highs, and the highs were set 2 Decembers ago, so December of 2021. So we're still not back to all-time highs or anything like that. We're not out of the woods yet, but at least we're making some progress, and having some meaningful gains here to start the year. Looking over some other areas, bonds are, they're only up a little less than 1% year to date. They're still down about 12.8% from their highs as well. Inflation's still high. It's coming down, but still sticky. And we're just kind of, for lack of a better term, when I talk with my clients, I call it purgatory. We're sitting in purgatory. We don't really know what to do. Well, I shouldn't say we, but when I say that, I mean the economy and the market as a whole. We're just, we can't really break out of this funk and get to new highs, but yet things aren't looking terrible right now yet either. We're just kind of in this middle ground. So that's kind of just a really quick recap of the markets themselves and market performance. Anything that you've seen, Adam, in terms of your portfolios or anything in your world? I mean, is education still, college tuition still projected to keep climbing at SMSU, or?
So we're gonna get into that bubble, huh?
Well, I mean, it always goes up. It's just a matter of I get the data after the fact, so I didn't know if is education going to keep chugging along and going up at 6.5% average clip, or because of everything that's going on, are they backing that off, or are they increasing it even more? I mean, I just got my auto insurance renewal and they jacked up rates 20% and then claimed that they needed to do that over last year because of inflation. Well, I had a talk with them and I asked where they're getting data showing 20% increase in inflation, because the highest it's been is between 8 and 9. But there's just different industries are handling all of this in significantly different ways. And so I was just curious if you had any thoughts on the real estate side, or not real estate,
higher education.
The education side.
Yeah, I could speak to specifically the state of Minnesota, and our chancellor. So the Minnesota State colleges and universities, 7 universities, 52-ish community colleges and technical colleges. So our chancellor has approached and the state of Minnesota budget biennium, and they are campaigning for $300 million, I think. And part of that is to keep a tuition freeze. So I think $150 million of that is to keep tuition the same. So for the state of Minnesota specifically, there shouldn't be any increased tuition in the next 2 years. They're asking from some of that surplus, the $20 billion surplus, to invest some of that into keeping tuition where it is right now. So there's your answer for the state of Minnesota specifically.
Wow, that's fantastic. That's really good. Kudos to Minnesota. Hopefully other states follow that. That'd be really nice for any of the young people out there in high school heading off to college or in their early careers of college to not have tuition, to get that tuition free. So that'd be really, really nice. So yeah, that's kind of the markets in general, just really going over that. Let's see, other things recently. In January, the Federal Reserve met. They raised the interest rate by another 0.25%, or a quarter of a point, in January here, which is a significant slowdown of what they had been doing. They were at as high as 0.75, and then in December they moved it down to 0.5, and then now in January 0.25. I think that is goes hand in hand with why January started out so hot and has been so good, was because that is slowing.
Why did that one
There
seem to
are
go? Maybe it's just my fault, but why does that one seem to go a little bit under the radar versus just because this 25 basis points versus 75?
yeah.
Yeah.
Yep. I mean, I think that it's there's a few things to it. Yeah, one, I think you're exactly right. It was less of a rate hike, so less of a significance in that regard because it's not as big of a jump. Um, the other part is, we've said it before on the show. We as a society have a short attention span, and we've been talking about federal rate hikes for, you know, 6, 8 months, and we start to lose interest and don't care as much anymore. And it's not the hot new topic. And especially when it then goes down and isn't as big of a rate hike, it's not as deemed as important. I'd probably say those were kind of the two main things of why it wasn't as big of a deal. And then the markets are doing well, so people want to focus on that. And they go hand in hand. I really believe that they go hand in hand with so just kind of laying this out at the market itself, and that's built up of all of us, right? All of us investing in the market, and that's professional money managers, that's regular people investing in through their 401ks, it's governments, it's hedge funds, it's everybody. Day traders, like that all makes up the market. Businesses buying back their own stock. I mean, all of those things have an impact on where the market is going. And the sentiment seems to be that because there was this lower rate hike, that the Fed is thinking inflation is getting under control. Now, they raised this at the end of January, and here we are, middle of February, and we're starting to see that no, that's not the case. More reports are coming in. CPI came in last week. The housing starts came in yesterday. And those numbers are sticky. They're the housing starts are still down. CPI is still high. Even core CPI, when you take out some of the higher volatility areas, is still sticky. It's still high. The Fed has its work cut out for it, yet we're not in the clear. And so personally, I think that people saw that 25 basis point rate hike and thought, great, we're on our way to no more rate hikes. We're in the clear. Let's start buying. Everything's fine. And actually some people, analysts and people out there who project or try to project, I guess I should say, what they think will happen with rate hikes, started believing that there would be rate cuts before the end of 2023. And I think that's absolutely bonkers to think that. I don't think that there's any way. Now, I very well could be wrong. There could be something that comes up. If we happen to go into a big recession, they likely will cut rates. But just none of the data shows that we should cut rates at all in 2023. So, but anyways, I think that is what has led to this really hot start to the year. And then once things start going up, you get the FOMO effect, right? We've done a show on that. What would it be, a year or two ago, with GameStop and the day trading and that craze. Bitcoin was a craze as well. Like people, they have a fear of missing out, so they just start buying, and you start investing based on emotion rather than basing on logic and data. And so that's really kind of pushed it up to start the year, and we'll see if it can continue. I have my skepticism on that. We'll get into that in just a little bit. But I think that is kind of what's happened with start of the year, and then the Fed rate hikes there in January. Projecting that out a little bit, the odds right now are that the Fed will raise interest rates again, another 0.25% at their next meeting when they can raise them, especially with the new data that's come out.
So what are we at now?
Again, 4.75, I think 4.5. Let me look that up. 4.5. Yep. 4.5. And they call it, I know we've gone over this in a previous episode, but they call it the dot plot. It's what the actual members of the Fed create, and each of them gets their own dot, and so that's why it's called dot plot, but where they expect rates to go in the future. And that was previously in January, that was getting capped out at maybe they get to 5 total as a high. Now it's starting to seem like, no, maybe they might go over 5. We'll just have to see, because just as a reminder to everybody, what they have done is raise interest rates, right? And so quick analogy on this, in case you missed one of our previous shows going over this, is the Fed raises interest rates, and that makes it more expensive to borrow money from the banks. So that means then the banks turn around and charge you more money to get a loan. So it slows the economy down because it's not as easy to get money. It costs more to get loans. And so it starts to slow that down. Well, it's not an instantaneous thing. It's not like a light switch. People or businesses in particular, who've been working on purchasing a $10 million building may or may not just flip that switch and say, oh, interest rates went too high, we're not going to do this anymore. They may be too far down the path where they're going to follow through with it, or they might have locked in their rates before this. What it does is it slows down future development, but that takes time for that to work itself through the economy. And so, it's a 3 to 6 month lag. So we're seeing right now, February, we're seeing, what would that be? What happened in August? Somewhere August through October timeframe is of those rate hikes, we're now finally starting to see in the data. So we still have, at least we have November, December, and January rate hikes that are not part of the data at all yet. And that's a 75 basis point, a 50 basis point, and a 25. So that's 1.5%. Is my math right? Yeah. Yep. 1.5% total. That hasn't come through yet. And so that's why the Fed has started to slow down. They've gotten high enough, fast enough, and that's what they said why they've slowed down to the 25. They're letting the data try to catch up so that we can see how much more we need to do. But that's the problem with what I see the problem is of declaring this victory too quickly, that I feel like happened in January, is the data just is not there yet. Like we don't have any data. I keep telling clients there's 2 things that have to happen for the markets to make an actual recovery out of this. And the first thing is we have data that shows we've gone into a recession, which is not there. As much as people want to say it's there because of the real estate market, it's not there on the economy as a whole yet. Very well could be in the real estate industry, but that's not our whole economy. That's one piece of it. So we do not have the data yet showing that we're in a recession. So we would either need the data showing we went into the recession, and then data showing that we are making progress out of it. And then the markets would be like, okay, we're on our way out of this. Things are looking up. We're good to go. Okay, well, we don't have any of that. Or the second thing is we need data to show that we've hit this perfect soft landing that the Fed is trying to achieve. But again, we don't have the data for that either. And that data, none of the data it's like 3 to 6 months out from right now. So, I think it's a little premature to be calling victory, or to call a soft landing or any of that. I mean, we just don't know yet. And that's why, no one has a crystal ball. We've said it on the show before. If anyone tells you they know exactly what's going to happen in the future, you need to run away from that person, because they have no idea and they're just trying to sell you something by being overconfident. My, what I call cloudy crystal ball is exactly that. We don't know. We have to wait for this data And because we have to wait for it, the markets tend to focus on short-term things that come out, and then they'll either spike up or spike down a little bit. And I think we're going to sit here on this teeter-totter, go up a little bit, go down a little bit, go up a little bit. We're just going to not really do a lot for the next 3 to 6 months because we have to wait for actual data to come out. And then it just depends on what the data says, good or bad, whether we're going up or, maybe down a little bit. So, I think.
What are those KPIs? What are those key performance indicators or data that you look at? Just a ton of them, or
KPIs?
Sorry,
that's funny.
A marketing term.
Oh, I know it is. That's totally a marketing term. That's why I laughed. The Fed does not look at KPIs.
Well, I'm talking specifically you. When you say data, what are some of those quick pieces of data that you say it's not there or you're looking at?
Right. It's what the Fed. Right. It's not a crystal ball. It's very cloudy. It's what the Fed looks at mostly, because at the end of the day, it doesn't really. I don't want to say it doesn't matter what I look at, but it really doesn't, because it's all directed on what the Fed. Some economists who are not part of the Fed think the Fed should be looking at other things as a way to say, see, inflation has peaked and it's coming down and it's at this rate. Well, the Fed doesn't really care. They don't care what those people think. They look at what they look at. So to me, those are the most important things. And I'll get to what they are. But those are the most important things because the Fed is who determines where interest rates go. These other economists don't. They could be right. The other economists could, but it doesn't matter because the Fed is the engine that is going to power this one way or the other. So the Fed looks at CPI, so Consumer Price Index. They also strip out some things that are very volatile, like energy and food prices. And then they look at what's called core CPI. One of them that they're really concerned about right now is rental income. So because during the pandemic, the federal government put a freeze on rents and housing prices went up 50 to 100% basically everywhere in the country, but rent prices didn't because they were frozen. Well, now rent's catching up, right? Because they're supposed to move in tandem with one another. So now rent is really getting expensive and having a big impact on inflation. They look at manufacturing numbers. They look at housing starts. I mean, they look at tons of things. Unemployment is a really big one. Unemployment is historically low. We're really, really low right now. And as we've said on a previous episode, it's a weird thing, but that's bad. That's bad for inflation. To have inflation come down, people need to lose their jobs. And it's such a weird thing to want to root for. But at the end of the day, the inflation harms everyone. And so it's what's worse, some people losing their jobs or everyone dealing with inflation. They're both terrible, but the Fed has to pick one, and they've picked inflation is worse. So I'd say those are kind of the main areas that they're looking at. And it all just is what is encompassing and builds into inflation.
I'm just, as a consumer, from a consumer standpoint, I'm just worried that prices will just never go down. I mean, like, everybody's baked that into, from a business standpoint. I feel like cost of goods and groceries, just going to the grocery store, for example, paying that price of whatever it is, it just doesn't feel like it's going to get any better. Can you talk to that?
You're exactly right. And that's what the Fed's fear is that they don't get inflation under control quick enough, that the increases just become baked in, and all of a sudden, instead of food prices going up an average of 2% per year like they had been, that was roughly what inflation was over the last decade, or more really. So instead of things going up at that rate, well, now they're going to go up at 4, 5, 6%. And that becomes the new standard. And every year companies are baking that 5, 6% in, and it becomes embedded. And that's what happened in the 70s. And that's why the 70s and I think it went into the early 80s, but that's why they had to, once they finally figured out we can't just let inflation do its thing and we need to try to help out a little bit, they had to crank up interest rates super high, like 17, 18%. And it's because they waited so long. So that's why, again, and we talked about in a previous episode, that's why the Fed is acting or was acting so aggressively last year with these 75 basis rate hikes, one after another, to really ratchet it up quickly, because they want to get it under control as quickly as they can. And now they're at that inflection point of, okay, we did a lot. We're going to let some of the data catch up, because if they would have continued, let's say hypothetically, they would have continued at the rate of 75 basis points in December and January, and then do another one here in February. I mean, that would be too much too quick, and all of a sudden you could really throw the brakes on the economy and throw us into a very severe recession because of that. So they're trying to walk this tightrope, and we'll see if they are able to do that or if they fall off. But what you're talking about with grocery prices, those aren't going to come down. I mean, the prices that things have gone up, like I mentioned, for auto insurance, mine just got jacked up 20%. That is never going to come back down. And that's one of the things I asked them, okay, so once inflation gets under control, you guys going to lower this back down? Well, it's all bit, it's like, no, it is now, that is now the new baseline, and it will only go up from there. Hopefully in future years, it goes up less because inflation is lower and all of that, but it's not coming down. These are the new prices of things, unless it's a commodity. Food's a little bit different. Gasoline prices, things like that, they can ebb and flow, but for the most part, like, things are, this is the new norm. And then it's just a hope that people's income is able to keep up, and that people are getting, raises of similar amounts to keep them with the same buying power. Right.
No.
And if you're not, then you're losing out to inflation. So that's what the issue the Fed's really grappling with. And I don't envy them, because regardless of what they do, they'll never be right. They could do the best that they can, and there's going to be people out there like, you should have done this. Well, of course, hindsight's 20/20.
It's not a very enlightening episode, is it?
I think it's reality. Like, not everything's roses. When we do these quarterly reviews in 6 months to a year from now, hopefully things are roses then, and we'll be talking about how great everything is. I mean, this is how the economy works. That it doesn't go straight up.
Who's feeling it worst? Current retirees, folks that are entering or trying to enter retirement, or young people?
That's a really good question. I think there's a few categories. I'm going to split it into workers and retirees. Okay. I think if you had to pick workers or retirees, I would say retirees are going to feel it harder, just because they're on a fixed budget most of the time for most people. Social Security did have one of its largest increases, so that helps. But then, of course, Medicare went up almost similarly. So really, it's like treading water in regards to that. If retirees have pensions, most pensions don't have a cost of living adjustment. So that really hammered those people, because, your pension is set at whatever, and inflation was a lot higher, and you don't get to go up with it. People that don't have a pension, or I guess even if you do, but then you have, 401k or some sort of retirement asset as well. Those, the markets were down last year, so you're taking out the same amount or maybe more money last year because things are costing more, but the markets are down, that has a bigger drag on your overall retirement plan success rate. So I would, yeah, that's kind of the case for retirees, and it's something that you definitely needed to hopefully have planned for ahead of time. Trying to figure it out after the fact is never a good idea. As far as workers go, I wouldn't necessarily say that it is a timing of young people versus people closer to retirement. I think it's more of a socioeconomic standpoint. People that make less money, it's hurting them a lot more. Their increases in salaries, if they're getting them, are not keeping up, across the board. And so it's already, maybe a challenge for them to pay certain bills or to do certain things. And then as inflation stays high, inflation, it hurts everyone, but it hurts lower income people and families the most. Definitely hurts them the most. So, whether you're retired or whether you're working, if you're kind of in that group, then definitely feeling the pain a lot more than Warren Buffett is.
Yeah, I feel real sorry for that guy right now.
Well, you got to throw out extreme examples. So
sure. Do you want to break down industry overviews at all, or?
Yeah. Let's chat about a few of these. Any you want to go over first? You got any industries that are interesting to you?
Well, I'm just as the Fed kind of cools it down, and we're seeing interest rates get lower, and or their increase of basis points lowers, and the U.S. dollar strengthens. This is an assumption in a speculative market, but I would assume that the digital currencies might come back once we establish or reestablish the strength of the dollar. Is that a fair statement or prognostication?
Like Bitcoin and,
well, I feel like
whatnot, Ethereum and all those.
It blew up in 19, 20, 21, and then it just seems like kind of an afterthought right now. I don't know. It just doesn't seem everywhere like it used to be.
Yeah, well, we did an episode on this much more in depth on Bitcoin itself, and then we did one on Sam Bankman-Fried, SBF. I think that's actually the bigger driver right now, is everything that went on with that, letting that work itself out. I know Bitcoin's come up from its lows, but if you look back at Bitcoin and Ethereum, they in that industry, they call them the Bitcoin winters, or whatever, where it will have a craze and people will have, again, the fear of missing out, so people invest, and then it loses favor and goes down, and it'll sit there for a while, and then it'll become a craze again. And so maybe this is another one of those cycles. We'll see. I don't know. I think we're, again, as we talked about on previous episodes, I think the technology is here to stay, the blockchain technology. Whether the coins are or not, who knows? I'm not one of those people that thinks it's going to supplant the US dollar. I mean, that's ridiculous, in my opinion, that's even being floated out there. But of course, a lot of times you got to watch out, because the people that are pushing that probably own Bitcoin at $1,000. So the more that they can tell everyone, get in now and push the price up, the more they make money. I mean, like that's the aspect we all have to remember in all of this, is people are, for the most part, you're selling something, and anytime, whether it's real estate, Bitcoin, REITs, annuities, life insurance, there's a commission attached to that. And so they're, gold and silver. Oh my gosh, we're going to go into a worse recession than the Great Depression. Okay, I'm not sure what data they're looking at, but that data doesn't exist currently for any of that to be stated. But they're trying to get people to buy gold and silver because they're trying to work off of the fear factor. So, it's either fear or greed, right? Either they want to scare you out of something to buy something else, or they want to make you feel like you're going to miss out on it. And now I'd say that's more of the Bitcoin side of things is, get in now because prices are low. And so will it come back? We'll see. That it's, in my opinion, it's got to actually find a way to be utilized more than it is. I mean, it's just a token coin, really. I mean, not a lot of, I don't know any places. I'm sure there are, but I don't know a lot of places where you can go and be like, here, let me pay you with my 0.0000001 Bitcoin for this candy bar. Like, it just doesn't exist right now. If 5 years from now that becomes more prevalent, okay, now there's some value here because it is more like a currency. But right now, that doesn't exist here. So, yeah, we'll see if that one comes up or not. But I think it's more based on the industry has to build back the trust after what happened with SBF and FTX and whatnot.
I didn't see any FTX commercials, Super Bowl commercials this year. Weird.
Yeah, well, I guess that's what happens when you're going through bankruptcy and charged with numerous amounts of fraud.
Yeah, no Tom Brady. Sad day. Do you want to touch on the impact of AI and how fast that is compounding and improving, and how that might be weaponized? I don't know if that's a good word from a financial institution standpoint, but also from an individual standpoint. Is there a way we can utilize that technology to grow our wealth? I don't even think I'm a technology guy, and I haven't even tried it. I've just seen the memes and other people talk about it. So
yeah,
it's kind of scary.
This one but it's exciting at the same time. It's both. Like, it excites me, but it scares the crap out of me.
I've seen this movie before.
And I'm not concerned about creating iRobot basically. Yeah, I'm not concerned about that level. But it's more of like, so what we're talking about is Chat GPT is kind of the big craze. It was started by OpenNote. No, I can't remember the company. It's something Elon Musk is invested in or owns or something like that. And basically it's an AI, and you can go in there and say, write me a song about the Kansas City Chiefs, and it'll write you a song about the Kansas City Chiefs, or write me write me here's some information, and write me a resume, right? What are the best interview questions? I mean, you can ask it to do virtually anything. I was reading an article the other day that it passed a coding test
oh boy
for like Google that was $183,000 job. Like, it passed it. So it theoretically could be hired to do this $183,000 job. So anyways, that's Chat GPT. Then there's also Google's version of it called Bard. Seems to not be working as well. It had some issues and some hiccups, but that's their kind of competitor. Super, super interesting. I think it's going to be, it's all going to depend, and it always is. Is it used for good? And what it is used for good is going to be amazing. It's going to make things so much more efficient. It's going to save tons of time. I was reading another article that some huge law firm, can't remember if they're in Canada or if they're here in the States, but they are using this for they have 3,500 plus attorneys. And they expect that by utilizing this software to help do research, it's going to save every attorney between like 2 and 4 hours a week. I mean, now multiply that by 3,500 attorneys and 52 weeks out of the year. Think about how much more efficient
by just
that
finding
business
case
is
law,
going to be. Yeah. Yep. By searching and finding the case law and like reading through it and saying this applies to your case, this doesn't. And like here's things that you can cite. And then, of course, it's like reviewing it, but it's basically like having a paralegal that's way cheaper than a human being and way more efficient, and it's going to do it way faster. And again, like, so the efficiency that this could create for business is what's super exciting. Now, The bad part is education. My wife's in education and teaches high school choir, so she doesn't have to deal with this. But some teachers do, because kids have found this and are saying, write me a 3-page essay on blah blah blah, and so it's doing their homework for them. So now education is going to have to change, because you basically can't let kids do anything at home and turn it in, because you have no idea whether they wrote it or Chat GPT wrote it. Everything's going to need to be in the classroom so that they can, which causes its own headache, because then how do you have homework? Like there's benefits to having homework, right? Like being able to take work home and figure it out and do it on your own is a skill that you learn from having homework and going through education system. But if that gets taken away, like it could have, ramifications of a lot of things. It could juice your resume, there's going to be ways that Chat GPT is utilized to make people or situations better than what they would be if that person did it themselves. And, if that is you getting hired because Chat GPT did something rather than you doing it, well, then they should hire Chat GPT, not you.
Yeah.
So it's super interesting. Again, there's always pros and cons of technology, but I think the big pro and the exciting side is how companies can leverage it to create lots of efficiencies and give more time. We're looking into it for Harmoney Wealth. Like I've been looking into that. How can I try to utilize Chat GPT or Bard or something to automate some of my, for lack of a better term, brain numbing activities that I have to do, that they can get off of my plate, which will open up more capacity to me to spend more time with my clients or with new prospective clients, and doing the things that are more important and the higher functioning, brain power things, rather than, hey, here's some mind numbing things, but they got to get done. So I got to spend time doing it. So, that's kind of where I think I see that industry or that sector going. But definitely exciting area right now.
Maybe it'll come up with our next podcast episode.
Very well could. Very well could. I probably need more. Maybe 2 from now. I need a little more time to research.
Anything else you want to talk about quarter 4 market update that we missed?
No, I think we touched on most of these things. Last one, I guess, would just be, I'm getting questions on it. Should people be investing internationally? Just kind of real quick with it. Obviously, this brings up the spy balloons that have come over and everything, with China on that. And we'll see that whole thing just confuses me, to be honest. Like if we have satellites, and if China has satellites that could see the same thing, why are you doing spy balloons? Like it just and why would you release all of these spy balloons at the same time? And I'm just like, it just, because that we're gonna find them. Like I don't know. It seems, I'm not trying to call it conspiracy theory. I'm just really confused. Like, what's the tactic? What's the play here? Why would you do this? It just doesn't make any sense. But that has, worsened relations with the United States, or caused more tension right now. So, they've recently just slapped on some sanctions on a few companies in the United States. And so internationally, I don't know. Over the last I don't know how far, multiple decades we're talking, the United States, if you invest in the United States, you would have outperformed international. So the track record is not in favor of international companies. The other aspect of that is if they kick out a dividend, or if you sell it for a gain later on, well, now you got to turn around and pay foreign tax, because you owned a foreign company to the United States government. So you're giving up some of your gains to a foreign tax, plus then paying income on it anyways. And so maybe this is me being a loyalist to America, but I don't really see a ton of reasons right now to be dealing with international. If you do, small amounts. Don't put tons over there. We're still the world power in terms of economy and technology and churning everything out. So all the growth and income's here. Most all, I guess I should say. So yeah. But yeah, it's interesting times around the world. So I think it's easier to just stay here and do the things that we know. But other than that, because I've been getting that question a lot, is the international side of things. And then just real quick, touching on it, I know we're getting close to the end of the episode. The real estate market, that's softened. Obviously, I personally think it's going to likely continue to soften until people get used to higher mortgage rates. I would love to be wrong. I don't see us getting back down into the 2 and 3% interest rates again for quite a while. That was we need to remember that 5-year period or whatever where mortgage rates were that low was the anomaly. 10 years, if you're going to say anything under 5%, that was the anomaly. You go back even to the 2000s through 2010, regular interest rates were in the 6s. Well, that's where we are now. So we very well could be back to historical norms, and this may be where it sits. I mean, we don't know. I don't think there's any guarantee. I know a lot of people say there is, but I don't think there's any guarantee that we just all of a sudden drop right back down to the 2-3% within the next 6 months to a year. I don't know. The Fed would really have to cut rates hard to do that, and I don't see that happening. So, but people need homes. If it stays where it is, this will be the new norm. People will get used to it and buy houses just like they bought houses from 2000 to 2008 or 2010, whenever interest rates started going down. When interest rates were 6-7%, people were buying houses. They were still buying them. And they've bought them all through history. So it's just we need to get used to this being the new norm if that's the case. So I think there'll be a little lag on that, but I think then housing will pick back up because people don't want to rent for their whole lives. They want to own a home.
Very good. ChatGPT,
yes, sir.
Write me an outro.
Yeah, there you go. Maybe that should be our first one. We'll test it with that next time.
Yeah. I might have to play around with that.
Yep. So any thoughts that you have? Anything you want to throw in that exciting for you over the last quarter?
Nope. Just we took a little dip into the pool with just real estate and looking at another house, and
nice.
Got scared away just because of the interest rate we have on our current house, and if our pain point exceeds the value that we would get in return. So it just wasn't there yet. And yeah.
Well done. That's a great analysis.
So we're at that point of, do we just invest money in renovating our house, our current house, or making sure that the next house achieves and provides solutions for those big pain points? So yeah, I don't know.
Lots of options. Options are a good thing.
Sure. We're a little spoiled with our current interest rate. So waiting to refinance is not exactly exciting to me at this point. So, but we'll see.
All right.
That's it for us in this episode of the F Sharp podcast. Support the podcast by pressing that follow button, leave a 5-star review, and most importantly, tell a friend. If you have any suggestions or questions, shoot us an email. You see the email right below at podcast@financiallysharp.com. That's podcast@financiallysharp.com. Thanks for listening, and you will hear us in the next episode. You also see us in the next episode since we're on YouTube. So, how was your first experience with YouTube? I found myself going,
I liked it.
I can't dink around as much as I did when Tanner's talking because I'm kind of on screen. So Greta says I kind of have a scowly face and resting RBF, which, I'm aware of, but I don't think I did a very good job of hiding that. So we'll see.
Nah. I think you did good. I thought there are definitely times in previous episodes when I could see you, but we're not recording the video, where I'm like, is he even listening to anything I'm saying, or am I just talking?
You're just talking.
So
Gotta do the Wayne's World.
Yep. Throw that in every once in a while. But
all right.
No, I liked it. I think it's good.
Adios.
This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, tax, financial, or other professional services. Investment advisory services are offered through Harmoney Wealth, a registered investment advisor authorized to do business in states where registered or otherwise exempt from registration. If you have questions pertaining to your specific situation, please contact Harmoney Wealth at 602-935-5155 or at harmoneywealthaz.com.